Right, welcome everybody. Oh, we've got some likes, so that's a start. Welcome everyone. This is the much publicized on the group Q&A with Roderick Sam, who we're very privileged to have join us this evening. Roderick has donated some of his spare time, some of his spare time on a Sunday is some cherished time, so thank you very much. We've got a hello already. We're off to the races. Excellent. Can you see that comment?
No, I can't see anything.
Oh, all right. Okay. You'll have to take my word for it. We've got a hello. Yes. We've got some likes. We've got everything.
So I'm a bit blind at the moment. All I can see is you.
All right. I see. Fair enough. Cool. Anyway, so as I say, Roderick has been very generous and given up some of his time for the group, which is excellent. We're going to record this so that people who haven't had the time to join us tonight will be able to see it later. And I think this is a really wonderful opportunity to ask anything you like to a qualified FA, which is remarkable, really. Anything, no holds barred, anything you fancy. Obviously, we can't give financial advice, but we can give broad information about investment accounts, things that you might like to do, things that you might find interesting. 50 people, that's absolutely amazing. Anyway, over to you, Roderick. Thank you so much for joining us. Roderick just wanted to do a quick intro for everybody so he could explain who he is, what we're aiming to do tonight, and then we'll jump straight into some questions.
Thanks, James. It's really good to be here. I'm not going to give too much of an intro because, to be honest, I'm probably not all that interesting anyway. and I think your listeners would rather ask me a load of questions, but please be gentle. Yes. So essentially, for me, I've been in the financial service industry probably for about 8 years now, and how I see it is, it's helping people make good decisions with money, putting in place a plan for the future. But the thing is, things change along the way. So rather than being a defender of an outdated map, it's been a guide in a changing landscape. So for my clients, I provide investment, pensions, protection, and also mortgage advice. So the whole, I guess, holistic financial planning suite. And really, I think about 6 months ago, I kind of changed the way in which I work with clients, and started trying to kind of work more with dentists as a profession. I think with the advent of technology, the old days of geographical location is kind of less important. So kind of specializing in a profession is kind of how I saw me working going forwards, and focusing on dentists is like a great group to work with. Why dentists is probably what some people might think. My wife is actually a dentist. She's an NHS dentist for a practice where we work, and she's always asking me at the start of at the end, I guess, of the year, when she gets her ARR, is this right? Is my MPE right? And always I'm asking, maybe, but give me more information. I don't think you guys kind of know really. Or kind of the NHS pension is really complicated.
It is,
should we say? So
tell you what, when we had Luke Hurley speak on that, I just thought a pension was a pension, but wow, the level of depth to that, you need a degree in itself to understand it, and that's on top of all the other things we have to worry about. That was brilliant.
I don't think you need a degree. All you need is just to find someone who can explain it in simple terms.
Yeah, no,
hopefully that's.
I'm kidding. Yeah.
Yeah, that's what an advisor does. Explain things in simple terms, so you can understand it and kind of see how it all fits into your plan.
Awesome, brilliant. Were you finished? Sorry.
But yeah. No, as I say, I don't want to kind of talk too much. We've got 1 hour or whatever. So let's kind of get right into it. Let people grill me.
No, nothing of the sort. Just gentle questions, of course. That goes for everybody. Gentle questions, everybody listening. Roderick is this is Roderick's spare time, of course. We want to give his mind a bit of just ease him out of his Sunday, shall we say. What was I going to say? Yeah, I'm actually going to struggle not to talk during this because I do a lot of that. So I'm going to be like this. My lips are sealed. going to let Roderick do 90% of the talking, and I'm going to learn things as well. Just to let everybody know, the questions, the feed, there's a little bit of a delay between you guys typing the questions and them appearing on the feed. So when we will get to them, they take about a minute to reach us. So if you fancy throwing up your questions now, they'll be there in due course. We have had some anonymous questions from the group. Shout out to everybody who's already said hello, actually. Hello, Jenny. Hello, Ishida. Hello, John. Hello, Joe. Joe's got a question. Hello, Anika. And hello, yeah, John again. We already have those questions. So those questions are great. Keep them coming. Just so that we can let those fill up, we're going to answer some anonymous questions that we've received in the meantime. So whilst we're doing this, if everybody throws all their questions up, that would be great. Cool. So Roderick, you said that you had a anonymous question from the group. Is that correct?
Yeah. So I had an anonymous question. So we might as well kick off with that one then. So yes, so someone asked me.
Let's do that,
yeah. Someone asked me. They've just started kind of 2 jobs, and they think they're going to earn between 100 to 125k. I was kind of concerned about the tax and wanted to know if it was kind of best to make pension contributions. You know, I think we actually touched on this when we spoke last time, James. That
we did.
Yeah, what happens is that kind of when you're earning between 100 and 125k, you are heavily penalised on the tax, and you know you're taxed at something like 60%. What it is so everyone has a kind of a personal allowance as an amount which you kind of have tax free before you start paying tax. You know, this year it's 12,500, but once your earnings kind of exceed 100,000, you lose £1 of allowance for every £2 of income over 100,000. So essentially, if you've got kind of income over 125k, you know, you lose your allowance completely. So kind of as a consequence of that, you know, you essentially pay 60% tax. I mean, if we give an example, or if I give an example, so if you're earning, say, in simplistic terms, if you're earning 101,000, you know, you pay 40% tax on that £1,000. We'll just use that part of, you know, for this example. You pay 40% tax on that £1,000, so that's £400. But because, you know, you're earning over that £100,000 threshold, you know, you've lost £500 of your allowance. So if you remember, you know, you lose £1 for every £2 over. That's £500, which means you have to pay 40% on that additional £500, which is £200. So for every £1,000 of earnings within that bracket, you know, you've paid £600 worth of tax, which is effectively 60%. And you know, the easiest way, or kind of what we would normally suggest to mitigate that is making a pension contribution. So you know, with obviously the person that asked, you know, that would be the most obvious way to make a pension contribution to kind of reduce your taxable kind of earnings, to save, well, effectively 60%. So you know, it's not a bad way of doing things. Hopefully kind of that answers your question. I mean, if it doesn't, I'm happy to pick it up with you afterwards, because there's some nuances that I kind of want to explore with you. Because if you're kind of, well, I'm assuming you're an NHS dentist, so you're probably already paying into your pension. So you know, when you say you're earning between that band, you know, you might already be paying contributions that takes you out of that kind of 125 banding. So yeah, you know, if it hasn't fully answered it, I'll pick it up with you separately.
Awesome. So it becomes way more efficient when you're earning at that level. It's definitely something you encourage people to think about when it gets to that point, if I gather that correctly.
Mm-hmm.
One more, guys, amazing questions. Thanks very much. Keep throwing them up. We have one more anonymous one, and then I'm going to start answering ones from the feed. I can see them all here, so thank you so much for that. The second anonymous question we had, it reads, if investing and buying shares through a limited company, what tax are you liable to pay? Is it just capital gains tax? and what are the pros and cons of investing through a limited company?
That's probably a good question. Probably it's probably something to pick up slightly separately, but I guess you can invest through a limited company. I'm not, it's not something that I know too much about. Yes, you'll have to pay capital gain, not capital gain, corporation tax on kind of anything that you do, or any gains within the company that you invest in. Pros and cons. You obviously at some point you're going to have to extract the money out of the business. So you will pay dividends or kind of income tax at some point in time. But really, it's kind of, with financial planning, it's coming back to what's your plans, what's your goals, what you're trying to achieve. Is that the most efficient way of doing things for your circumstance?
Cool. Yeah. So case by case basis. What level does corporation tax kick in?
What level? Oh, everyone pays businesses pay corporation tax at 19%.
No, I mean, is there a threshold before it kicks in? So the way you've got your base rate tax, your higher rate, additional rate, and it kicks in at 12.5 grand. Does the base rate?
Right. As far as I'm aware, I don't think you get any kind of allowances in that respect. But your accountant might be better poised to answer those kind of questions.
Cool, no problem whatsoever. Brilliant. Hope that was the answer that you were looking for. The person who posted that anonymously. Right, let's get on to some questions from the group. So Joe was asked. Joe would just like to know where you're based, Roderick.
Where I'm based. So I'm based in Evesham. For those that know where that is, for those that need a bit more of a geography lesson, it's in Worcestershire, kind of on the edge of the Cotswolds. I mean, I've only been here 3 years, so so even I'm still trying to find my way around. But kind of the Worcestershire area is probably the easiest.
Where did you live before?
A bit of a nomad, actually. I kind of spent 5 years in Liverpool beforehand, Wigan. My wife did her kind of second degree, so her dentistry degree, in Preston. So that's kind of why we moved up north to Preston. But I'm actually from Yorkshire originally.
Interesting stuff.
Not too far from where you are now. I from Sheffield, so yeah.
Sheffield is what it said. I've actually never got around to updating that. I'm actually in Leeds, but we're still not too far from each other.
Yeah.
I lived in Leeds. I came to England 10 years ago. I lived in Leeds for uni. I moved to Sheffield. I made it away from Leeds for 1 year, and then I came straight back. So I've got friends here. So yeah, I've not the most exciting. I like what I know, basically. I like Leeds. It's a good city. Brilliant. Right, Annika has jumped in. Annika has just remarked that the stream is perfect. Thank you very much for your nice comments, Annika. We'll move on to the next one. John Mahoney would like to know, what percentage of your income should you ideally be investing in your NHS or private pension? Am I right in saying that might be a difficult one to answer, Roderick?
It's quite a difficult one to answer, I guess. I mean, with your NHS pension, you don't really have a choice, because depending on what you're earning, you're stuck into certain bands in which you have to pay contributions on. Then if you would kind of look on the private pension side of things, it's partly comes down to what you can afford as well. I don't think there's no hard and fast rule, but with the idea of saving, I mean, I think you've mentioned it many times, James. It's just about the compounding effect. So start saving what you can, have regular direct debit or something like that. So the money goes straight out of your account. You get used to the idea, and then it's kind of building from that part.
A really nice method of investing. I think a lot of people, where the investing message becomes a bit aggressive or maybe a bit muddled or confused, is that people think that it's something that you have to put all your money into. I think before you even start thinking about any investing, it might be nice to have 6 months to a year's spare cash emergency fund,
Oh yeah, yeah.
and then go from there.
No,
Yeah,
definitely. You know, when we kind of sit down and speak to clients, we always say you need at least 3 months to 6 months kind of emergency fund.
yeah,
So you know, 6 months of expenditure, because you know, if we look back at, obviously, when we had lockdown one, you know, dental practices, they were all shut down for how many months. So you know, you guys got no income and needed to draw on your emergency funds or whatever to kind of help you survive effectively. So that's
100%.
why we always say, yeah, you know, minimum 3 months, 6 months. People might want more. You know, we all have different attitudes to what we want as nice cash in the bank. So yeah. And I guess to add to that layer as well, we also say that, you know, if you've got a known fixed expenditure in the future at some point, you know, then don't use that money to invest, because you know you need that money to pay for something. So I don't know, a good example would be like a house deposit or something like that. If you know you need to put 10% towards that house deposit, don't invest that money, because it's a known fixed expenditure in the future.
Yeah, so once you, obviously your six months to a year's spare cash is an amazing thing to have, and that should be a priority for a lot of people. And definitely I dipped into that over coronavirus. After that, a really nice investment portfolio is 20% cash, and then you, after of your spare capital, that is 20% cash maybe at all times, just in case cash is a hedge against shall we say, downturns in the market. So it's always nice to have some of your portfolio in cash and then play around with the rest. It depends on you as an individual and your age. People prefer to put a certain amount in stocks, certain amount in bonds, maybe in gold, maybe in crypto. It really depends on your individual circumstance, I suppose. So we'll move on to the next question. We've got Chaya has said hello. So hello, Chaya. And Wachu has asked, what stage do you decide to buy property as a limited company, e.g. if one property sole trader, but at what level do you then buy a limited company? Did that make sense, Roderick? It's kind of I'm trying to decipher this one a little bit. Let's just say, how about this? At what stage do you decide to buy property as a limited company? I guess that would really depend on quite a few things, wouldn't it, Roderick?
I mean, it's a good question, but it sounds like it's individual to you. So you know, I think that one is how long's a piece of string. It's difficult to say. I mean, I would need to know what your kind of circumstances are in order to kind of properly answer that question for yourself. You know, for some people it could be they want to start straight away. You know, for others that they may not even want to look at kind of property within a business. I mean, you know, me personally, if we talk about myself, you know, I'm not really interested in kind of buy to lets and that kind of thing. I just don't really like the hassle of kind of having buy to lets, you know, void periods, the repairs and all that.
It's so heavily taxed, isn't it? I mean, once you get past your first property, it's so heavily taxed.
Yeah, no, there's definitely a tax element, and you know, who knows as well what's going to change in the future. You know, with what's happened with coronavirus, there's been a lot of borrowing. At some point, the government are going to have to repair the coffers a bit, shall we say? So it's you know, there are going to be probably some hits on various tax breaks. Talking about CGT or capital gains tax, there's murmurs that might be reduced from 12,300 at the moment to possibly down to 3,000, 5,000. But you know, who knows at this point in time? But
another reason. Yeah, we'll see. Well, at the minute, nobody's paying. What's that tax? When you buy your house for the first time, you get an exemption on it. What's that tax? What is that tax?
Stamp duty holiday.
Stamp duty, yeah. So they don't have stamp duty at the minute, but they think that stamp duty is going to come back with I was speaking to Harry Singh on, well, I think it was the very first podcast actually. That was about 2 months ago, and he reckons that stamp duty will be back any, when they review this, the Chancellor reviews this imminently, because to me it's a very obvious way that they're going to claw back some of this Corona money.
Mm.
And you're quite right, the capital gains one would be an obvious place to look.
Yeah, I know.
So yeah, that is.
I think that talking about stamp duty, I think that they may give some leeway for kind of first-time buyers or those kind of house movers, but if you've got looking at investing and trying to take advantage of that they'll probably cut that one short, because they need to recover some money somewhere.
Seems an obvious place to make some money, so I think they'll probably do that, to be honest. Right, brilliant. Hope that helps, Wichel. You might want to get some more tailored, nuanced advice on that one. Maybe sit down with an FA. Kevin Kitt has said, evening, Kevin.
Evening.
Very nice to have you here. Next, next we have Ashish Shah. Ashish would like to know, would you recommend having a private pension as well as an NHS pension, as it reduces your tax liability and helps bridge the gap along with ISA allowances in latter years, since the NHS pension age for withdrawals is almost 68 now, for the 2015 NHS scheme? I don't see any reason why that would be a bad idea in principle. I suppose to do both. Roderick?
No, totally agree. I mean, in principle, it's not a bad idea.
Go on.
Pensions.
I'm just going to get some water.
Pension or private pensions at least offer a lot of benefits as well in terms of IHT planning. So again, it's probably slightly dependent on your circumstances and largely down to affordability as well. But having both isn't a bad thing. Yes, with the NHS pension, you can't take it until kind of state retirement age. Private pension, you can take your 25% tax-free cash from 55, going up to 57 in a couple of years' time. But yeah, no, if you can afford it and you like the idea, then it's definitely not a bad thing to consider. Again, that's just kind of on a general basis, and you need something more specifically tailored to you. So happy to kind of talk a bit more about it if you want to talk about your circumstances.
Yeah, great questions, guys. I think, Roderick, if I'm right in saying you're trying to toe that line between giving information but also not saying anything too tailored, because of course we need to, I suppose you need to know quite a lot about the exact situation there to be able to say exactly what you might do, I suppose.
Exactly.
Yeah, fair enough.
There is a fine line to toe, but I'm trying to help as much as I can at the same time without giving, I guess, specific advice or whatever to an individual.
Got you. Fair enough. Hope that helped, Ashish. We've got Annika again. Annika says her financial advisor is keen on her distributing money into a SIPP, an ISA, stocks and shares, and life cover. Do you think the 40k ceiling will be reduced in SIPP due to a tighter allowance?
Difficult to say. I mean, again, it's one of those kind of tax breaks where they could target. There has been murmurs to change the tax relief to a flat rate tax relief of 20% rather than kind of getting higher rate relief as well. So it may happen, but like anything, that nothing will happen retrospectively. That they will give some advance warning. So at the end of the day, I guess it's also making sure you use all your available allowances. If you've got the capacity, make sure you use all your allowances. I think someone told me that, but don't quote me on this, but there's apparently about 2,000 allowances out there.
Really? Wow.
I couldn't name half of them, I guess, but
yeah.
It's just making sure you can try and use all those that are available to you. So yeah, your ISA allowance, your capital gains tax allowance, or your other kind of general, more well-known allowances, I guess, dividend allowance as well.
I guess someone, what, are you still there, Roderick?
Yep.
Yeah. I guess someone Someone might say, Annika, just to turn that question on its head, that maybe if you think that that's going to happen, like Roderick says, it won't happen retrospectively. So maybe now is a good time to capitalize on that 40K limit. I don't know. Obviously, no one knows if it's going to change. And as well as that, it would depend entirely on your circumstances. But you might just flip that logic on its head slightly and argue that just as another interesting way of looking at it. I think some of the investment vehicles in the UK, investment accounts, they must be the envy of the world. Where else can you put in £20,000 to your ISA, your £20,000 ISA limit, and have tax-free on your profits? I think that's just insane, really. I know America have a 401k, but I can't imagine there's a serious amount of revenue there that the government miss out on, and they're happy to do so to encourage people to save and invest for their pensions. Interestingly, you'll know more about this than me, Roderick, but not so long ago, the ISA limit was only 3K. When was that? Was that?
Oh, you're asking questions far, but yeah, that would have been quite a while back. I mean, it's been 20K for a good number of years now. I mean, when it first started out as Teslas or whatever they were called, the limits were a lot lower, and but it's been 20K for a little while now. And I think in the group they've also talked about JISA allowances or junior ISA allowances. That's 9K at the moment, so that's not a bad way to put aside a little nest egg for the children. But obviously, caution on that side of things is that if you do set up an ISA, when the children become 18, they get access to that money. So depending on how good they are with the money, they could buy that nice car or whatever it is. But yeah, it's just something to be aware of.
I wouldn't have trusted myself at 18, I'll say that. I hope that helps, Annika, and I hope you're having a good evening and weekend as well. Annika was on the podcast about art. It was actually Annika that I did it with. So that was an interesting one. Really knows your stuff on art. Smashing. David Hoy, we've got next. Good evening, David. Assuming good health, what is the chance of claiming on life insurance from the age of 40 to 65 and critical illness?
Actually, funnily enough, I don't know if you you probably didn't do the little quiz that I put together, but in that I think it said that the kind of average age for a claim for income protection is about 40, and the average age for a claim on critical illness is about 47. So I guess take that how you want. I couldn't say exactly for what it would be for, what was it, 45? Did you say 45 to 60?
David said 40 to 65.
40 to 65. So yeah, I mean, the average age, as I say, for income protection is 40. So you kind of possibly in that age band already. I guess just to add to that, again, I kind of was told or I've seen some statistics to say that I think the reassurers had to pay out something like £90 million during the pandemic. So at some point you think that they're going to look to recover costs. And the most obvious place is obviously the consumer. So if you don't have income protection or don't have critical illness and are thinking about it or haven't even reviewed it for a little while, now might be a good time to have a look at it before they start really kind of increasing costs or whatever. I know, James, you're not overly keen on the idea of protection.
Yeah. Well, I mean, income protection is maybe one that I would categorize. Generally speaking, I'm not really a huge insurance product person, but that's just my belief system. That's not to say that I'm right and everyone else is wrong, 100%. Income protection, I think that it probably is useful for a lot of people. Definitely, yeah. I actually, income protection is unique, and you might argue, we had Vinay chatting about income protection actually, and he was saying, for £100 a month or whatever it is, the insurance that it buys you, he believes is really important. It's all about getting a good one. But yeah, no, income protection is something that I'm for. I just wouldn't buy it personally. Having said that, I could have done with it a few times when I, you know what I
Exactly.
mean. So I could very well
I
be
mean,
wrong
I
there.
mean, the analogy that I always use is, if you had a tree at the bottom of your garden that kind of grew money, would you insure it?
True that. True that. Good point. I like that.
Okay.
You would, wouldn't you? Yeah, very good point.
Well,
Okay,
yes.
cool. Cool. David, thank you for that. We've got Louise McGilton next. Louise has said, hi, for a beginner looking to start simple and fairly low to moderate risk, what's the recommended after the usual SIPP, stocks and shares ISA, and utilizing mortgage offset? Well, you could, of course, you have got your 12,300 capital gains limit, so you can always take advantage of that with a general investing account, in addition to the things that you mentioned. Anything else you'd like to throw in there, Roderick?
Yeah, no, I mean, I think you're right there. It's the your general. If you've used up all your other allowances, then your next obvious one is your general investment account, where you've got your kind of £12,300 CGT, and you know, not only that, if you've got a spouse, you can actually transfer assets between each other freely. So if you've kind of used your allowance, then you could potentially transfer assets to your other half and use their allowance as well if they haven't used it.
Yeah, the level of tax wizardry always blows me away when I talk to an accountant or a financial advisor. There's so many ins and outs and things that you can do to save yourself money. It's actually quite interesting, I think, despite the received wisdom that tax is inherently boring. Anything else you'd like to add to Louise's
Uh,
question?
no, not not not
Yeah,
not not anything else I can think of off the top of my
fair
head.
enough. Cool. Awesome. So hopefully that was useful, Louise. We've got John again. How are you supposed to plan when the government continually changes the goalposts regarding pensions, NHS pension, moving in line with state pensions, earliest drawdown of private pensions moving from 57 to 55, lifetime? Wow, there's a list. There's a whole list here. I think we get the message. Yeah. What do
Yeah,
you what
no.
do you think on that one, Roderick?
What do I think? Well, this is why. I mean, biased or not biased, I'd say, get an advisor. You know, get an advisor, speak to them, so you can, and find out what your goals are, and then what you're working towards. Invariably, they say, two certainties in life, death and taxes, but the third one is change. So it's yeah, there's always going to be change. So it's just about navigating that change and tweaking that plan or whatever to get to that ultimate desired outcome of independence, financial freedom, whatever that may be.
I like that actually. Have a plan and then just tweak it as you go along, I guess, is a good response to that one. Because a lot of these things are unforeseen. I don't even think the government know what the government are going to do come the new tax year, come the new budget, they're probably just making that one up as they go along themselves. So they're
It's,
probably going to,
it's like investing though as well, isn't it?
yeah,
You don't see all these um, kind of things happening, and nobody in the world saw coronavirus coming, and obviously
do
that
that.
hit the markets quite heavily at the start of 2020. Yeah, markets recovered, but there's always these events that nobody sees, and but we just have to deal with it and carry on, and maybe have a slight change of course.
It is good that you're really thinking about those sorts of things though, John, because that's the first steps to having a plan. Dan Hardy Punia said hello. Hello, Dan. I hope you're very well and you're having a great weekend. We have Elaine Moe next. Elaine would like to know, in your experience, what are the common mistakes or often missed knowledge that dentists are not aware of with regards to financial planning? Really great question.
Um, Common mistakes. I mean, you know, I guess that the first common mistake is not getting advice. I think yes, or education as well. First of all, you need to educate yourself on these things, but also, why not educate yourself by speaking to someone who knows, a professional about it. Like dentistry, you don't go into dentistry reading your own books or whatever. You go, you get some learning, you get taught about it. So yeah, I think people, I don't know what it is, maybe about advisors that people don't quite like or whatever, that we may want to take your money, but at the end of the day, we're kind of there to help you as well.
And you know, the common pitfalls that you see every day, like errors that dentists commit. I know that so what you've done is you've given us a great idea of somewhere to go, but say, what is the most common frequent mistakes that you think that you see dentists make, that you kind of almost have your head in your hands, or you frequently have to sort them out? Taxes, is that one?
You what, sorry?
I just said, is it taxes? Is taxes an example of one?
Yeah, I mean, taxes would always be an example, I guess. Not using all your allowances, not really saving. I guess that there's the whole mire of things, but at the end of the day, it's that there are lots of little things which can be looked at. But yeah, you need to start somewhere.
The taxes one, I'm sure there's a few out there who try to fill in their self-assessment themselves. I've actually done it before myself, but having talked to guys in tax, I just realized how many things I could have taken advantage of. There's a list the length of your arm, and from having conversations with people who are involved in tax, I probably won't be doing that again. I'll be honest with you, because it's actually, I actually believe that it's worth it. Whatever it is, when you're outlaying a little bit for the tax man, if you look at it purely in terms of economics, you'll actually probably save more if you get a good accountant. That would be my sort of personal anecdote to add to that one.
No, actually, I agree with you there. That is a really good one there, because an accountant will be able to save you probably a lot more tax than you're paying them.
Totally. I wish I would have taken that into account. I wish I would have had more of an understanding of that before I did endeavor to do it myself. But yeah, the education thing is amazing. Like when you start reading about money, it really is a huge rabbit hole, and you realize about 3 years ago, I didn't even know what a stocks and shares ISA was. I'm sure there'll be people in the group who will say the same thing as well. So the only reason I got from there to learning a little bit more about it was just education, taking an interest in it, and if anything, I just find it interesting. So yeah, it's an interesting one. That cool. Thank you, Elaine. We've got Nishal saying hello. Hello, Nishal. Hope you're very well. Wachul has just said thank you for answering the question earlier. You're welcome, Wachul. Thank you for the question. It was a good one. And we've got Imran Ahmed now. NHS Pension, Imran asks, or stick to ISAs, property, etc., that you're in control of, especially if you don't want to work to anywhere near state retirement age. What do you think about that, Roderick?
We always said the NHS pension is a fantastic pension. It's guaranteed. It doesn't matter how much you put into it. You know what you're going to get at the end of it, unlike obviously your private pensions, where it's all about kind of money you put in, the investment returns is what you get at the end. So it's generally, I would say, stick with the NHS pension. There are obviously some circumstances or some individuals where it might not be appropriate to stay in the pension, but again, it's probably slightly personal. So I would always, at first point of call, generally say stay in the NHS.
Cool. Yeah, all I know is that people that I talk to who seem to have a background in finance, I haven't found one yet who's told me that they think that the NHS pension is not a good idea because of how lucrative it is in the long run. Luke Hurley, again, fleshes it out really nicely in the podcast that I did with him. Really interesting one was that. I learned a ton about how that works. Hopefully that helps, Imran. We've got Sheila Lai next. Sheila would like to know, after reaching your ISA allowance, is it better to use your limited company to invest in stocks and shares? Oops, it's just jumped around. Or pay into a SIPP? Good question, Sheila.
SIP's a great place to pay money into. You know, because any employer contributions into a SIPP, it's an allowable expense. So you save kind of corporation tax straight off there. You know, obviously the negatives to that is that you can't access your SIPP and your SIPP private pension, whatever you want to call it, until at least 55. So you know, from a tax planning perspective, generally I would say put money into a SIPP rather than investing it. But you know, again, people have different views on that, but that's kind of my general view.
There's also, just as we said earlier, Sheila, I don't know if you caught it, there's also your capital gains limit is 12,300, so you can always take advantage of that limit before you start thinking about SIPs and things like that. If you are into investing in your ISA, it totally depends on you. There's no one shoe that fits everybody, but that might be something you want to consider too. So if you just open any old general investment account, like I say, capital gains doesn't apply until you make 12,300 profit, I believe. Roderick will confirm that. Yeah. Yep. Awesome. Anil has jumped in. Oh, this is good actually. This is a little bit of financial history. This is interesting. He said that ISAs were originally TESAs.
Yep.
TESAs. Yeah, is that correct? Max 3K investment, then they became PEPs, max 6K investment, then ISAs. The max investment for a TESA was 3K back in the very early 1990s. Thank you for that, Anil. I didn't know that. Anything else? Any more financial history you can add to that? Roderick, I find stuff like that fascinating.
Probably not. I think, you know, he's either very knowledgeable there or yeah.
Yeah, that was
so nothing.
That's good. That TESAs and PEPs. That's a new one for me. Thanks for that, Anil. Louise has said, "Thank you for answering your question earlier. You're welcome." And we have Richard Lishman next, who has said, unfortunately, he's able to. Yes, Richard. Richard would just like to know if we can watch it at a later date. I'm recording this right now, so everything will be thrown up on the groups for your viewing, and whoever else is interested, just as soon as this is over. We're hoping to wrap this up by 8 o'clock or just before, guys, depending on how many questions we get. Chan David, welcome, Chan David. Nice to see you this evening. Chan would like to know, what's the most efficient way to take profits out of your Bitcoin? Good question.
Bitcoin. Well, I'm going to have to kind of, you know, put my hand up and say I don't know much about Bitcoin. So maybe, James, that's more of a question for you.
I would say on that one, that long story short, you would probably need to speak to an accountant, because what they can do is, I believe, and Roderick will confirm, I was chatting to someone about this the other day, if you announce that your profits are, say Bitcoin's going to go up in value, okay, or it's likely to before the end of the financial year, so before the end of March, so you can declare your profits on it now and pay some capital gains tax. And then if you believe that it is going to go up, then when you do eventually sell or you cash out, you'll pay less tax, because it's apparently they account for this in the tax system. Is that correct, Roderick?
I think it sounds like it's probably best to speak to an accountant.
Yeah, definitely. Yeah,
that's one that specializes in crypto.
Yeah, you can. That's obviously just a rule of thumb, or it's a possibility. So that's not advisable for everybody, and I definitely would double check that. But there is sorts of things that you can do, that sort of wizardry that you can do to make it more tax efficient. As well as that, if you don't sell your Bitcoin, you don't pay taxes. So you might just like to hold. You might just like to hold it the whole way through, hold it to ad infinity. It's a hard one when you're trading, because there comes a point where it might be considered income tax as well. So again, definitely one to have a word with an accountant with. I don't know how frequently you're buying and selling it, David. So that might be something you'd like to consider. I think what we're hoping to do in the very near future is get a Bitcoin tax, cryptocurrency tax expert on the podcast. So watch this space for that one, Chan, but I hope that helps. Definitely one to have a word with an accountant with. You're welcome. Oh, Chan's just said thank you. You're very welcome, Chan. Sheila Lai again. Thanks for the question, Sheila. These are great. What is the most efficient way of taking money out of your limited company?
Again, that's probably slightly more of an accountancy kind of question, but that they generally say take some salary and dividends, because the dividend tax is slightly lower than income tax. But it depends also how much you need to extract from your company as well.
Yeah. The only real advantage of, correct me if I'm wrong, Roderick, the only real advantage of paying money into a limited company to invest is that you pay the corporation tax, but you get taxed twice if you do it.
Mm-hmm.
So it really depends how much you're investing, how long you hold it for. There's a few variables in there, Sheila, but that's why people are so keen to do it if they're a higher rate taxpayer. I've understood it correctly, haven't I, Roderick? Yeah.
Yeah. No, you have.
Banging. Okay. Thanks, Sheila. Sheila's got another question. So she said, capital gains tax, you mentioned, and using money to invest in a GIA. Would it be tax efficient to take a dividend and invest it in a GIA versus just directly using the limited company to invest in the GIA? I'll throw it over.
Sorry, say that again.
Does that make sense? Sorry, I think I kind of lost myself there. Capital gains tax. So what Sheila would like to know is it more efficient to take your dividends and invest it in a GIA versus just directly using the limited company to invest in a GIA? Hard to answer that one, is it?
That's probably quite a difficult one to answer. It's also, are they going to be investing in exactly the same things? I'm not quite sure how to answer that one at this stage. I'm quite happy to pick this one up separately with you, Sheila. I think it's probably the best way.
Great questions. I think that, Roderick, you might be struggling a little bit because you don't have enough information really to answer them fully, and you wouldn't want to give unsolicited advice. But that's not to say it's not a good question.
It's a really good question, actually. I'm sure lots of people are probably in similar boats as well, but I think that's kind of a bit more personal to Sheila's situation. So, happy to pick this up separately.
Cool, fair enough. Hope that was all helpful, Sheila. Pedro would like to know, is it a good idea, if you don't need the money that is, to invest in a SIPP private pension, the income you make per year above the high payer threshold, in order to minimize the tax that you pay on this?
So, say that one again.
The problem is, I'm reading them out literally, and some of the words, the wording is slightly ajar, or it's slightly confusing. What Pedro means is that when you pay the higher rates of tax, is it a good idea to invest in a SIPP? I think that's what he means.
Paying the higher rates of tax. So is this? I guess is it from a?
It's more additional, really, when you think about a SIPP, really, isn't it, Roderick?
Yeah, I mean,
that area.
I guess I need to know, kind of, are we talking through a limited company, or I guess
we'll go personally. We'll just go personally.
I mean, obviously paying into a pension is always advisable. There are great tax savings for paying into a pension, but again, it's a lot of it's driven by affordability as well. So by the sounds of it, you probably don't need that surplus cash. So use your allowances. But again, I think it seems a lot of these questions are quite personal to people.
No, of course, yeah. Just do your best with what you have, and I wouldn't want you to feel like you say anything uncomfortable that you're not happy with.
As I say, use your allowances. If you can afford to pay into your pension, then great. There's huge benefits of paying into a pension long term. Okay, yes, you have to pay kind of tax on the way out, but you do get your 25% tax free, and there's ways that you can be efficient with how you draw your money. on the other end. Yeah, hopefully that's kind of partly answered your question. Again, like with the others, happy to pick it up separately. Just speak a bit more about your own situation.
Yeah, the reason, obviously, as we were saying earlier, we can't give advice, I suppose, unique to your situation, Pedro. But the reason that people generally tend to like SIPPs is to reduce the tax bill. It usually becomes a lot more economical when you hit that. It's just over 100K, isn't it, Roderick? Where your personal allowance begins to be eroded, because for every I can't remember the exact figure, but for every pound you earn, you only earn like 20 pence at that point, or something silly like that. Once you have,
so between the 100 and 125 bracket, you're kind of taxed at 60%.
Is that how much?
So
it is, yeah. And then that's as well as that, you've got your national insurance on top of that too, I believe. Yeah. So it becomes so uneconomical to earn over that threshold. That's when a SIPP is generally something that people consider. Again, in no way financial advice, but something that you might like to take up with an FA or kind of use to help make your decision on that one, Pedro. Happy with that, Roderick? Anything else you want to chuck in?
No, I think, yeah, so if you want to pick this up separately, more than happy to have a chat.
Cool. Awesome. We've got Depeche Kothari. Welcome, Depeche. No worries on being late. Because you've just apologized here, I see, so that's no big deal. Depeche said, did we discuss critical illness cover? We kind of did, didn't we?
We touched on it, yes. I mean, has he got a specific question around it, or is it just
it just says, did we discuss critical illness cover? I guess what Depeche, reading between the lines or analyzing the question, he'd just like to know, do you think it's a good idea and do you think it's worthwhile?
I think it's a good idea. So critical illness is kind of is totally separate to like income protection, because income protection pays you a regular income if you're unable to work. Critical illness pays you a lump sum if you are diagnosed with a specified condition that the insurer sets out and survive normally around 30 days. So yeah, no, there's definitely a reason to have both. Again, it's about looking at what you have and seeing what your own liabilities are in order to put something in place, and generally affordability as well. You find that critical illness generally is about 3 times more expensive than life cover, because you're more than likely to fall with a critical illness than not. I think the little quiz I did, cancer's kind of the biggest reason for critical illness, and if we look at 1 in 2 people or whatever, again, to get cancer at some point in time, so you can see why insurers kind of put a higher premium on critical illness than say life cover.
It's the sort of thing you don't need it until you need it. Does that, you know what I mean?
Yeah, but that's the thing with any insurance, though. That's why people are slightly against it, because if you don't need to pay out for it, then you don't get any benefit from it. But on the other hand, those that need it and have a payout, they can definitely see the benefit.
Cool, awesome. Right then, so yeah, I think that's it for the questions. Chan David has just said thanks, he really appreciates it. You're very welcome, Chan. Sheila has said thanks too. Jonathan Lee has said, this is great stuff, guys. You're very welcome, Jonathan. I'm glad that you find this so useful. And Depeche has said thank you. And I think that's it for the questions, unless we get any within the next few seconds. We've actually really, we aimed for 8 o'clock, didn't we?
Yep.
And we're just at 2 minutes to 8. So I think now might be a good time to wrap up. No. If that's okay with you, Roderick. Thanks for coming on the show.
That's perfect. The time's gone quite quick, actually, to be
fair.
That
flew by. I tell you what, I can't believe that was an hour. Yeah, I feel like we've just started. I'm sure there's a million other things that we could flesh out, but I hope everybody has found this useful. I'm going to do more things like this on the group, because this is a really amazing way that people can ask Q&As, anything they like, to somebody who is qualified in that field, to give their answers there and then. So I think it's a brilliant format, I really do. But yeah, thank you so much for coming on the show, Roderick.
It's been great. It's been fun. I don't know any better way to spend my Sunday evening than to grill.
I'm sure that was sincere. I'm sure that was sincere. Right, cool. Well, if anybody wants to get in touch with Roderick, he's on the group, Roderick Sam. Feel free to drop him a message of anything that you heard tonight you'd like to think about a little bit more. There's probably a million things that we could flesh out. I hope everybody has found this very useful, and we're going to sign off for the evening now, everyone. So thanks for coming. See you later.